So today we're going to talk about a really sophisticated, kind of fascinating estate planning strategy that got the green light from the US tax court. It's called the net-net gift, and it's this wild technique that basically turns a potential tax risk into a real financial asset. Let's get into it.
Here's what we're going to cover. First, we'll look at the fundamental problem that really wealthy families are up against. Then we'll build up the solution, layer by layer, starting with the classic net gift and then leveling up to the net-net gift. We're going to walk through the incredible court case that made this all possible, uncover some major hidden risks you have to watch out for, and then, at the end, we'll figure out who this strategy might actually be for.
All right, first things first. If you have a ton of wealth, you face this huge challenge. It's really simple to say, but incredibly complicated to solve.
I mean, that's the billion-dollar question, isn't it? Every time you try to move a large amount of money or assets, whether you're alive or not, the taxman is kind of looming over your shoulder with his hand out. And the whole point of smart estate planning is to shrink that shadow as much as you possibly can. Now, there is a secret weapon for why wealthy people love to give gifts while they're still alive. It's because the gift tax is what's called tax exclusive. All that means is you only pay tax on the net amount your kid or grandkid actually receives. The money you use to pay the tax, that's not part of the taxable gift. The estate tax, on the other hand, is tax inclusive. They tax the entire pot of money, including the cash that's going to be used to pay the tax bill itself. It's a subtle difference, but it creates a massive incentive to make gifts during your lifetime.
So you're facing this huge gift tax bill. Planners came up with a pretty clever way to at least manage the cash flow problem. Let's look at the first level of this solution, the good old net gift.
It's pretty much exactly what it sounds like. Instead of you, the donor, paying the tax on the gift you're making, you make it a condition of the gift. You say, hey, I'll give you this, but you, the donee, have to pay the tax bill that comes with it. It just shifts who has to write the check to the government. And this is the part you really have to get about a standard net gift. Just look at the numbers here. It doesn't matter who pays the tax, the donor or the donee, the government still gets its $400,000, and the person receiving the gift still ends up with $1 million. So a net gift doesn't save a dime in taxes. It's really just a liquidity tool. It's for the donor who's asset-rich but cash-poor.
And a quick little side note here, this creates a fun little math puzzle. The value of the gift is actually reduced by the tax, but the tax is based on the value of the gift. It's this circular logic that kind of hints at the complexity that's coming up next.
Okay, now we get to the main event. We're going to take that basic net gift idea and go to a whole other level. This is the net gift, and this is where you can actually start to see some real tax savings. Here's the game changer. With a net gift, the recipient agrees to take on a second possible liability. See, federal law has this 3-year look-back rule. If you make a huge gift and then die within 3 years, the gift tax you paid gets yanked back into your estate's tax calculation, and that can create an even bigger estate tax bill. So in a net gift, the recipient says, okay, not only will I pay the gift tax now, but I'll also pay that potential estate tax down the road if it happens.
So think of it like a 1-2 punch. Step 1, the recipient takes on the definite gift tax bill. We know that's going to happen. But then step 2, they also take on the contingent estate tax liability, the one that might or might not happen. And here's the magic. The taxable value of the gift gets reduced by the value of both of those promises. One is certain, the other is just a probability.
Now, you might be thinking, this sounds great, but does the IRS really allow this? Well, for years, they fought it tooth and nail. They said you can't reduce a gift's value based on some speculative what-if liability. But that all changed with one specific court case. That wasn't just a win for one family. It rewrote the rulebook for everyone. And the case centered on this woman, Jean Steinberg, and an absolutely massive gift she made to her daughters. The IRS, of course, challenged her numbers, and that set the stage for a major showdown in tax court. So get this, in 2007, Mrs. Steinberg handed over nearly $110 million in assets to her 4 daughters. And as part of the deal, the daughters agreed to pay not just the gift tax, but also any extra estate tax that might pop up because of that 3-year look-back rule. And here is the absolute key to the whole case. At the time she made this enormous gift, Jean Steinberg was 89 years old. Now, at that age, the risk of passing away within 3 years isn't some vague idea. No way. It's a statistically significant, totally quantifiable risk that you can actually calculate with actuarial tables.
The tax court's reasoning here was just brilliant in its simplicity. They used the classic willing buyer, willing seller test. The court basically said, look, forget that this is a mother and her daughters for a second. Would any rational, unrelated person who's buying this property, would they look at this potential multi-million-dollar tax liability as a real economic burden? And the answer was, of course they would. And because it's a real burden, they would demand a lower price. That risk has real, measurable value. So, what was the final result? The tax court sided with Steinberg big time. They allowed the value of her gift to be reduced by an extra $5.8 million. That was the calculated present value of the daughter's promise to pay that potential estate tax. And that one discount saved the family over $1.8 million in gift tax right then and there. The net-net gift was now officially legit, and it opened up a whole new world for estate planners. Okay, this strategy sounds incredible, right? Almost like a silver bullet for gift taxes. But it comes with a massive, and I mean massive, hidden risk. If you are not careful, this thing can backfire any truly spectacular way. Here's the trap. For income tax purposes, the IRS sees a net gift a little differently. They treat it as a part sale, part gift. The sale part is equal to the liability the recipient takes on. And if that liability, the gift tax they're paying, is more than the donor's original cost basis in the asset, well, the donor suddenly has to recognize a capital gain. Yeah, the person giving the gift gets hit with a tax bill. Just look at how devastating this can be. In this scenario, someone gives away $10 million of stock that they have a zero basis in. Maybe it's from a company they started. The net gift saves them $200,000 in gift taxes. Awesome, right? But it triggers a capital gains tax of over $700,000. So they end up losing over $500,000 by doing this. The takeaway is crystal clear. This strategy is an absolute disaster if you use it with low basis assets. So after all that, who on earth is this super powerful, but also super risky strategy actually for? Because it is definitely not for everyone. The perfect candidate has a very specific profile. You need a donor who is of advanced age, in their 80s or 90s, like Gene Steinberg, to make that mortality risk really count on the actuarial tables. They absolutely must be gifting high basis assets, think cash or stocks they just bought, to dodge that income tax trap. The people receiving the gift have to be liquid enough to actually pay a huge tax bill if it comes knocking. And of course, the gift has to be big enough to even trigger a tax in the first place. And that kind of leaves us with a final, pretty wild thought. The net gift is really a masterclass in turning a liability on its head and making it an asset. It takes the statistical risk of a person's death, something planners usually work against, and it monetizes it to create a real, quantifiable tax discount. It makes you ask a pretty profound question. In the world of high-stakes estate planning, could your own mortality actually be the most valuable asset you have?